Hello. I am Carly Nussbach-Lowry. I am the Chief Legal Officer at Copper. For those of you who haven't met us, Copper is a London-based blockchain-agnostic infrastructure provider, which roughly translates as, we do some really cool stuff with custody. I am here to introduce Michael Hsu, who's the Acting Controller of the currency. Michael took on the role in May 2021, and through it, he is the administrator of the federal banking system and the chief executive officer of the Comptroller of the currency. He also serves as the director of the Federal Deposit Insurance Corporation and a member of the Financial Stability Oversight Council. I won't pretend that anyone is here to hear from me, so Michael.
Thank you for that very kind introduction and for inviting me to speak here today. I would like to provide a bank regulator's perspective on the recent turmoil and events in crypto. As many of your members know, I've been a crypto skeptic. In speaking to the Blockchain Association last year, I warned of risks in the crypto space, including unexplainable and unsustainably high yields and innovation for innovation's sake. What has become clear to me since then is that these developments are indicative of the crypto economy's dependency on hype. Hype is needed to generate the interest and investment that are key to creating the flywheel of growth that crypto projects seem to need to get off the ground. The recent collapse of the Terra USD stablecoin and associated sell-off in crypto markets has shown that hype-driven growth can lead to bubbles, harm customers, and crowd out productive innovation. I will say a bit more on this later. Stepping back, though, I would like to share 3 high-level observations from my perspective. First, the recent events of the past several months have revealed deep vulnerabilities in the crypto system. 3 in particular stand out. A, crypto is highly fragmented and prone to hacks. The crypto ecosystem has become increasingly fragmented with new blockchains being added daily. Cross-chain bridges have sprung up to mitigate interoperability challenges due to fragmentation. But these bridges are highly prone to being hacked. It's as if, instead of converging on a single standard railway gauge to connect the country, innovators are incentivized to build customized railcar systems from scratch. Then complex solutions are created on top of those to connect the systems, but they are, by design, easy targets for bandits. B, contagion risks are real. The collapse of the algorithmic Terra USD stablecoin sparked contagion to the largest stablecoin, Tether, and to the broader crypto ecosystem. This occurred despite the stabilization mechanisms for Terra USD and Tether being quite different. And yet, Tether experienced a wave of redemptions and depegged after Terra USD's collapse. Such contagion is familiar to bank regulators like myself and students of money-like instruments. Prudential regulation can help. Bigger picture, however, it appears that the hyper-focus on trading in crypto has created a highly interconnected ecosystem, something that became more clear after the collapse of the Terra ecosystem contributed to a massive sell-off in cryptocurrencies generally. C, custody and ownership rights are underdeveloped for the size, scope, and ambitions of the industry. As Terra USD was collapsing, the largest centralized exchange in the US disclosed that should it file for bankruptcy, its users would be at risk of becoming unsecured creditors. This disclosure renewed questions about the nature of the custody services that centralized exchanges and other intermediaries provide. For a technology and industry so focused on promoting an ownership society, the lack of clarity on ownership rights, modes of ownership, and custody of digital assets seem like a fundamental problem that needs to be solved. When consumers buy crypto or NFTs through an exchange or app, what exactly do they own? How are the bundle of rights apportioned? Who must they rely on to exercise their ownership? Establishing clear standards for the ownership and custody of digital assets would protect consumers, while enabling sustainable long-term growth. The second observation I would like to make is that recent events have shown the value of the OCC's careful and cautious approach to banks seeking to engage in crypto activities. Despite significant volatility and the loss of about $500 billion of market cap following the collapse of Terra, there has been no contagion from cryptocurrencies to traditional banking and finance. No banks are under stress or even rumored to be under stress due to crypto exposure. This absence of stress has allowed the traditional banking system to remain a source of strength to households and businesses through the recent financial market volatility. The resilience of the traditional banking system to the recent events in crypto is not an accident. Rather, it is due, at least in part, to federal bank regulators' continued and intentional emphasis on safety and soundness and consumer protection. At the OCC, this emphasis was reflected in Interpretive Letter 1179, which was issued last year and reminds national banks that engagement in crypto activities is permissible only when banks have controls in place to do so in a safe and sound manner. This includes compliance with applicable consumer protection laws to ensure that customers are treated fairly. With my encouragement and support, the FDIC followed the OCC's lead and sent a similar message via a letter to FDIC-regulated banks earlier this year. I believe that these reminders have contributed to the safety and soundness of the banking system, despite the heightened volatility and recent turmoil in the crypto markets. The third observation I would like to make is that hype is not harmless. I noted at the outset that the crypto economy appears to be hype-based. Indeed, it seems hype and yield are to crypto as user engagement is to social media. Consider the arc of the Terra USD stablecoin. It rose rapidly this year to become the third largest stablecoin from $3 billion last November to over $18 billion at its peak in May. How? By offering 20% returns to Terra USD holders who deposited their tokens on the Anchor protocol. This come-for-the-yield approach is not unique to Terra. Offering outsized yields appears to be the primary mechanism of attracting interest and investment in many, if not most, crypto assets, especially in the DeFi space. This mechanism is facilitated through so-called yield farming. There seems to be growing acknowledgement that yield farming today may have more in common with Ponzi schemes than with productive innovation. A hype-driven economy presents real challenges for those truly interested in productive innovation and in protecting consumers. There's real potential for positive and transformative change with digital assets, and ensuring inclusion and access to anyone willing to invest the time and effort to learn about those opportunities could facilitate wealth building for those typically shut out from such opportunities. However, the hype and associated vulnerabilities noted above make the crypto space very dangerous for investors with modest means. The Terra USD holder stories are heartbreaking and a strong reminder that hype is not harmless. Given the massive inflow of venture capital dollars into the space, my fear is that the hype problem may get worse before it gets better. Getting the inclusion protection balance right with crypto is going to take a lot of discussion and work. A paternalistic approach, prohibiting or discouraging investment, is as problematic as a purely laissez-faire approach. This is one reason I brought together Professor Tanya Evans, a crypto expert, and entrepreneur and philanthropist John Hope Bryant, a crypto skeptic, together to discuss cryptocurrencies and communities of color as part of a financial health discussion series sponsored by the OCC. It is also why I called on the Financial Literacy and Education Commission, which is chaired by the Treasury Department, with the Consumer Financial Protection Bureau as its vice chair, to prioritize improving crypto literacy and education. In sum, although I remain a crypto skeptic, I have come to see its potential and understand why there is so much excitement about it. The industry has grown too fast, however, and suffers from a hype-based shoot, ready, aim approach to innovation and value creation. The recent events in crypto should serve as a wake-up call and an opportunity to reset and recalibrate the problems the industry is trying to solve. Until then, the OCC will continue to take a careful and cautious approach to crypto in order to ensure that the national banking system is safe, sound, and fair. Thank you.